Welcome to this episode of Conversations to Have with Your Advisor. Markets have been volatile from September till now, and this has been due to multiple reasons and given out various reactions from investors. So let's see how one should move from panic to patience over the course of this journey.
I think it's a great initiative to try to take investors from their panic state of mind to a more patient state of mind so that they can participate and convert these events in the market into opportunities for wealth creation. So to do this, I think we need to study what's happened since September till today. And I think one way to do that is to break down this drawdown into two periods, right? So you had a drawdown period from September to March. And I think here there was a lot of fear in the investor's mind. There was a lot of questioning and reflection that was going on in terms of what they should be doing. Why are the markets behaving in this particular way? And there was a very wait and watch mentality when it came to investing in this drawdown phase. Actually, that's not the approach to investing. When you have these long phases of drawdown, investors need to participate more and ask less questions about why there's underperformance. The questions need to be more oriented towards where the opportunities lie. Right? If we look at the next phase, which was, let's say, your drawdown happened towards middle of March, from there, if we see to where we are today, there's been a lot less reflection that's gone on in the investor's mind and a lot more action that's been taken place in their portfolios. And this is because you had this period which was really difficult and then you saw markets bounce back. So the investor mentality is now oriented towards this idea that, okay, no matter how bad it is, markets will bounce back. But I think this is where we need to actually come back to the drawing board and see that the context for investing has changed between 2024 and 2025. So the approach to investing also has to adapt to this new context.
Definitely the context has changed. We have a lot of geopolitical tensions that are happening. So we still have Russia and Ukraine, which is still unresolved. And then we have Israel and Hamas, which is also unresolved. For a brief time, we also had the India-Pakistan border tensions. So there are multiple things that are causing a lot of volatility in the markets. And there has also been the whole issue with trade wars and tariffs and bilateral agreements being signed. So there are multiple reasons which is causing volatility in the markets. And we also have the growth estimates that are being revised. So definitely the context has changed. So let us see as to how we can cut out all this noise and what an investor must do today in the context of investing towards their own portfolio.
Like you rightly pointed out, the context has changed quite a bit, and investors don't give enough credit to context when it comes to making investment decisions. A lot of the times decisions are based on past performance or what they consider to be appropriate for their risk profile, right? So you might think small and mid caps is suitable for an aggressive investor, but in a certain market context that may not work. In a different market context, that might be the best option even for somebody who has a less aggressive risk profile. So this context and adapting to the context is very important. And I think in today's scenario, we can actually look at adapting to the context in two ways. The first is to acknowledge that we're actually investing in a slowing economy. So whether you're looking at India's slowdown in terms of growth or the global growth slowdown, you are going to participate in an economy that's simply not growing as fast as it was before. So there is a need to sort of revise your return expectations. There is a need to follow a completely different approach to investing. The second thing that you want to look at is in terms of the style of investing. So previously you could have had a passive or a top-down approach even to investing. But I think in today's context, knowing that there are a lot of tensions geopolitically, knowing that there is a lot of uncertainty on trade and therefore import-export dynamics, and to also know that you're in a slowing economy, I think these three things ensure that you need to follow a bottom-up approach. So what may seem as a negative for a sector or a theme may actually have few beneficiaries who might do better than average. And that succession of being better than average can actually deliver outlier performance, because that is going to be the surprise element. So this idea of moving from top down to bottom up, from a more passive to a more active approach, is something that many investors are still not mentally prepared for. There's a lot of debate on how passive or index-based investing can actually help an investor because they save up on costs. But when the context has changed so much, investors really need to come back to the drawing board and look at the cost that they're paying versus the benefit that they could get when they choose a actively managed product or a well-advised portfolio.
So what we understand is that the next 1 or 2 years is going to be a key investment phase and not really the best time for you to measure returns. So what can you do to cut out all the noise and act on your portfolio? Number 1, have a milestone. Always try to work towards certain milestones and certain targets that you want to set for yourself. Work with your advisor to see how realistic those targets are and how they can be achieved. So this will kind of help you to cut out all the noise and just focus on those goals and numbers and help you achieve those goals faster. Second is look at it more as an investment approach and what you are doing and contributing to ensure you're able to participate in all the opportunities that is in front of you, instead of debating about what is actually causing the volatility, what you should be buying and things like that. So have measurables that you can measure over a period of time. Work with your advisor what you need to do as an investor and what they will be doing as an advisor as well. So hold yourself accountable and ensure that you're able to measure it in your follow-up meetings as well. And lastly, keep your return expectations low and work towards the approach of building your portfolio, and whatever you're doing today is definitely going to reap you returns over a longer course of time, and you can measure your returns at that point. Thank you so much for watching this video, and we urge you to work with your advisor to set milestones and work towards that.